Okay, we're going to pick up now where we left off on Monday. I was hoping to be able to be a live webinar with you. I have a flight now that's taking off at 6:30, so I'll be online with you for a little bit, but I wanted to start capturing some of this information on screencast so that way you can review this over and over again. Excuse if you have noise in the background. I'm in an airport. But the key to this chapter is understanding the concept of debits and credits. When we're dealing with transactions, we're always going to balance it. We're going to always take the transaction and our debits will always equal our credits. Now, we may have more than just one account on a debit side, one account on a credit side that may be affected, but we will always have the same equal amount as far as the numbers go, the dollar amounts of credits as we do debits. So when we're dealing with what's called a double entry system, that means we don't just utilize and affect one of our accounts. We're going to affect two or more accounts, and those accounts will equal out. The debits will equal the credits. Now, a debit, as we talked about on Monday, only means the left side of an account. A credit means the right side of an account. When debits are greater than credits, then the account has what we call a debit balance, such as assets. So in this particular scenario, we see various transactions. Transaction 1 and Transaction 3 report a debit balance, and Transaction 2 shows a credit balance. If this would be an asset, then this Transaction 1 and Transaction 3 increase this account, and the Transaction 2 decreases this account balance. Now, if this particular account would be a liability or a stockholder's equity account, then the credits would increase an account and the debits would decrease an account. Now, we can just tell by the nature of this account. Sorry about the noise. We can tell just by the nature of this account that it is going to be either an asset or an expense because it has a normal debit balance here, as you can see. In this scenario, it's going to have a normal credit balance, so this is more apt to be a liability or a stockholder's equity account. No, and this is the key, this is so important, assets have a normal debit balance. Debits will always exceed credits, but liabilities have a normal credit balance. That means the credit side of the equation will always be greater than the debit side of the equation. The credit side of a liability increases the account, and the debit side of a liability would decrease the account. The same is true with stockholders' equity. And as we talked about with stockholders' equity, there are various accounts in stockholders' equity. There's a common stock, there's a retained earnings aspect, and we know the dividends aspect. So both common stock and retained earnings are going to have a normal credit balance because that's increasing the stockholders' equity account. When we have a dividend, that dividend decreases stockholders' equity ultimately because we're paying out, we're reducing our stockholders' equity by giving away those dividends, which reduces it. Revenues will always have a normal credit balance, and if we debit the revenues, we're reducing our revenues. As is true with expenses, that will be a normal debit balance. So remember, and again, if you need to go over this again and again and again, we will have a discussion where we go through problems because this is really the key focus on this chapter. Revenues help increase our stockholders' equity, and expenses decrease our stockholders' equity. Same as dividends, they decrease the stockholders' equity. So, as you know here, remember, normal debit balances will be assets and expenses. Normal credit balances are going to be your liabilities, your stockholders' equity, and your revenue accounts. So important to just be aware, assets are going to have a normal debit balance, and expenses are going to have a normal debit balance. Liabilities, equity, and revenues are decreased when we debit those accounts. So with assets and expenses, we're increasing those accounts with a debit. With liabilities, equities, and revenues, we're decreasing those accounts by debiting. The opposite is true with credits. If we credit an asset, we're decreasing that account. Same with an expense, we're going to decrease that account. But with a liability, with an equity, or with a revenue, by crediting that account, we're increasing those accounts. So really, if you have to just take this particular page and keep it beside you when we go through problems and various exercises, that's what you need to do until it really sinks in for you. So again, what we're focusing on in this particular scenario is to encompass everything that is in stockholders' equity. Ultimately, the common stock and the retained earnings is really what we have in stockholders' equity. But we know our revenues and expenses are part of our income statement, which ultimately then flow back into our retained earnings. When we pay out dividends, that's going to decrease our retained earnings. And so that's going to be a normal debit balance for dividends, because that's going to then decrease our retained earnings. Again, every time we create a transaction, that equation will always be balanced after every transaction. Debits will always equal credits, and our accounting equation of assets equal liabilities plus stockholders' equity will continue to be constant after every transaction. So let's look here. It talks about debits. Do debits increase assets and liabilities? Do debits decrease both assets and liabilities? Do debits increase assets and decrease liabilities? Or do debits decrease assets and increase liabilities? Remember, the normal balance for assets is a debit. So debits will increase assets. But the normal balance for a liability is a credit balance. So a credit will increase a liability and a debit will decrease a liability. So the correct answer here would be C. The debits are going to increase your assets and they'll decrease your liabilities. Another review question here for us is, accounts that normally have debit balances are they assets, expenses, and revenues? Assets, expenses, and equity? Assets, liabilities, and dividends? Or assets, dividends, and expenses? Well, you want to take a look, go back and check out that one page that showed the normal debit balances. A normal debit balance is going to be an asset, a dividend, and an expense. One way I like to think of it is when I pay for something. When I pay for something, I reduce my cash account. But when I pay for something, the opposite side of it will be an expense, so that's going to be a normal debit balance. When I pay for something with cash or pay out dividends, I'm crediting my cash account, which means I'm debiting dividends. Or if I'm buying an automobile with cash, I'm reducing my cash or crediting it, and I'm debiting that asset I'm purchasing. So I always like to think of where's the cash, and as a result of me using cash to buy something, if I'm crediting cash to buy something, then I need to be debiting the other side of the transaction. That's just my way of thinking through that. Everyone has their way that works best for them. Okay, so we're talking about this accounting information system and what we do in recording something. We look at each transaction. We look and see, is it something we need to record, or is it something that really doesn't need to be recorded? Again, it will need to be recorded if there's a financial exchange or commitment that has taken place. So what I'm going to do here is we're going to talk about exactly the steps in this process of recording it. So we're going to look at a transaction, and then we're going to, if we need to record that transaction, record it in a journal. And then after we record that transaction in the journal, then we're going to transfer it to the various ledgers. Now, how do we even know what to record? We'll have something called source documents. These are the original statements or slips, such as a sales invoice, a check, a bill, some transaction or some evidence, original document that was going to provide us with the information we need in order to record this transaction. So if you think about a checkbook, the checkbook, all those checks are going to be evidence of original source documents to report things. A bill is another document which shows that we owe money, and so we can use that to record an expense or an asset and show what we owe, which would be like a payable. And then a sales slip would be something showing that we have received revenue. And along with that revenue, we may be still or due the money, such an accounts receivable, or it may be that we received the cash. So the manner in which we record transactions, we first have to look at the information, and we look at the information by gathering these source documents and analyzing the source documents. Now, the journal is basically known as just the book of original entry. This is where we're going to record transactions just in a chronological order. Now, know that with software, we really don't do it in this manner that we used to when it was manually done, but the journal is where all the initial transactions are recorded. Now, when we are dealing with software, we would record the bill, and ultimately it shows up in the journal and it automatically goes to the various sources. But basically, this journal shows us a list of all the transactions we're reporting, and it shows it in a chronological order. Now, the important piece of this journal is our debits need to equal our credits, and especially when we're dealing with software, it's not going to allow us to enter something without the debits balancing and equaling those credits, which is nice. So what does it mean to journalize a transaction? It basically allows us to show the account, the amount, and the debit and the credit. And so in this scenario, we're going to take these three various transactions and we're going to journalize them. Now, we initially talked about knowing what account it's in and if it's increasing or decreasing an account. So we're going to take it a step further and really do some accounting work and journalize these transactions. As you can see here, on October 1st, Sierra issued common stock in exchange for $10,000 cash. We're going to take this and journalize and show exactly what we need to do for that transaction. We're going to also journalize the transaction of Sierra borrowing $5,000 by signing a note and then purchasing equipment. So as you can see here on this next page, when we show that they issued common stock in exchange for cash, we know that our cash increased $10,000 and our common stock, which is part of stockholders' equity, increased $10,000. So how do we journalize that? We basically show our debits first. We'll always show the accounts we're debiting first when we journalize transactions. So we're going to show the date, October 1st, cash, debited, because we are debiting cash because we're increasing our cash, and we know cash has a normal debit balance. Likewise, we're also going to increase our common stock. Now, by increasing common stock, basically what we're going to be doing here is crediting common stock because we know common stock has a normal credit balance. So you'll see this journal entry dated. We always show the accounts that are debited first. We're going to debit cash, and we're crediting common stock. You see, it's always balanced. Now, the next transaction was that Sierra borrows $5,000 by signing a note. we can see here that cash is going to be increased, and our liability called notes payable is also increased. So to journalize this transaction, we're showing cash as a debit for $5,000, and we're increasing our notes payable as a credit for $5,000. So cash has a normal debit balance. Notes payable has a normal credit balance. Both are being increased. So we're showing where we're debiting and where we're crediting. And then last, Sierra purchased equipment for $5,000. So in purchasing that equipment, we reduce our cash by $5,000, and we're increasing our equipment account by $5,000. So we're not going to use cash first. We're going to show equipment first, since that's the debit. Equipment was increased by $5,000. We're going to show that. And then we're going to show our credit, how cash is being reduced by $5,000 there. So when we're dealing with these, everything's going to be recorded into a journal. And then the ledgers, the accounts in the journal will show all of our debits and credits and which accounts. The ledger are all the accounts combined a company has. And so once we journalize a transaction, now the software will automatically take all of those debits and credits along with the accounts and put them all automatically into these specific accounts. Sometimes we have to do that by hand when we're doing a manual system, but fortunately we've got the software that allows us to do it the other way. Now, all these various accounts that we're talking about, all combined are called a chart of accounts. Chart of accounts is basically listing all the accounts companies use. Now, some companies may use certain types of accounts that other companies may not use. So, for example, I'm a CPA practice. I don't have cost of goods sold. Therefore, I don't have inventory. And I really don't have freight out, freight in, because I don't deal with, my business doesn't have those types of transactions. And so really each company will have their unique chart of accounts customized to the type of business. With Sierra Corporation, as you can see here, their assets are fairly similar. They do have a prepaid insurance account. They do have an unearned service revenue, which, as we talked about, would be a liability until they earn those revenues. And then the various types of expenses that are common with a lot of companies. Revenues may be unique. I have a service, so we provide tax services and audit services. Other companies may provide merchandise. So those revenues are going to be based on the specific type of account or company we're dealing with. So we record those transactions, and then after we've recorded them, we're going to take those and post them to the various accounts, which basically means transferring those journal entries over to the specific accounts. Again, with most software, they're going to automatically do that for you. So as you can see here, the general ledger shows this transaction. Well, posting it means going and finding that cash account and then posting it to that account. So from the journal, the general journal 1, we're going to show that $10,000 increased our cash account. So now, as of October 1st, we have a balance sitting in here of $10,000. And as you can see here, again, please be mindful of the fact software will do that, but it's nice to manually go through this process so you understand what actually is occurring by posting. So our review question here says, posting normally occurs before journalizing? I don't think so. We have to journalize first. Of course, we review and analyze the transaction, we journalize it, and then we're going to post it. Posting transfers ledger transaction data to the journal. Posting's an optional step, or posting transfers journal entries to the various ledger accounts. So D would be the correct answer here, because we have to journalize it and then we go back to those journal entries and we transfer them to the various accounts which are debited and credited there. So as you see, we have to analyze the transactions. We have to understand which accounts are involved, which ones we're going to increase and decrease, and which accounts are being affected. So really important to understand in this scenario, when Event 3, October, Sierra used $5,000 cash to purchase equipment. What's happening here? Assets are just being affected, cash and equipment. What gets debited, what gets credited, and then we go and post those things. So in this case, cash is going to be credited for $5,000, as you can see here, and our equipment for $5,000 is being debited. So this is basically the process of recording transactions. Really an important item to understand. Here, the same is true. On October 2nd, Sierra received a $1,200 cash advance from Knox, a client for guide services for multi-day trips that are expected to be completed in the future. So as you can see, cash increased, but since we didn't really earn that money yet, it's a liability which increased. So we sit there and think through what's involved, what accounts are involved, what's going to happen to those accounts. So we kind of think, okay, what's being debited, what's being credited. Then when we go and record the journal entry, we're always going to record our debit accounts first. And then once we have journalized these transactions, we will then post them to the various accounts that are involved. As you see here on October 2nd, cash increased $1,200, so we're showing that in that cash ledger, and our unearned service revenues increased by $1,200 there. And then as we move on here, on October 3rd, Sierra received $10,000 in cash from Copa Company for guide services. Our cash increased, our revenues increased, so we have to think through what's debited, what's credited. We then show the journal entry of cash increasing, which is a debit, of service revenue increasing, which is a credit, and then we post that transaction to those accounts affected, meaning the cash is going to increase $10,000 and our service revenue also increases $10,000. Here's another transaction. Sierra paid office rent for $900. Well, when they pay that office rent, cash is decreased. We're using up cash, and our rent expense is increasing. Our rent is increasing. It's ultimately reducing our stockholders' equity section. So when we record the transaction, we're going to debit our rent expense, and we're going to credit our cash. Again, we will then post that transaction to the appropriate accounts, account ledgers, and so you can see that on October 3rd our cash was credited or reduced by $900, and likewise our rent expense was debited by $900. The same is true as we look at this next transaction where Sierra paid $600 for a one-year insurance policy. Cash is reduced, and the prepaid insurance, since we've not used it up yet, is an asset. And so in one hand we're reducing one asset, cash, we're increasing another asset called prepaid insurance. Our journal entry will always show our debit first, our prepaid insurance, and then our cash is being credited. So you can continue and look on at these various slides, and you can pause this at any time and really make sure you understand why we're debiting one thing, why we're crediting another thing. As we look at this event 9, Sierra hired 4 employees to begin work. Each employee will receive a weekly salary. Now, this is not a transaction that needs to be recorded. Yes, an activity took place, but not a financial activity that we need to record. We'll only record it once we pay or those salaries have been earned. So once the salaries are earned, as you will see here in Event 11, then we will record this transaction because we paid employees salaries. So our $4,000 cash is reduced and our salary and wage expenses increased by $4,000. So here is our general journal that shows all of our transactions that we've recorded, journalizing, and then from there, when we posted them to the various ledger accounts, this is a summary that shows when we debited and credited by journalizing those transactions. We then are going to post them to these accounts in the same manner. So be familiar with how this works. In this Do It summary here are transactions or journal entries, and then to post these to the T accounts, as you see on July 1st, cash had a debit of $30,000. So we're going to take that account, cash, and debit $30,000. You see common stock has a credit of $30,000, so we're going to go over here to the common stock and credit that of $30,000. Likewise, our accounts receivable was debited for $6,000, so we show that. Our service revenue was credited for $6,000, and then our cash on July 24th was debited for $4,000, with our accounts receivable here being credited for $4,000. That is the posting to the account ledgers. After we've done all that, we'll come up with a trial balance. A trial balance is really basic. It's a list of every account a company has, and it shows the debits and the credits of all the accounts. Now they're listed into the order which they appear in the ledger, and the main focus here is that debits need to all equal credits. So as you can see here, based on those T accounts, all we're doing is taking our balances and we're showing cash. Again, we know that's a normal debit balance, supplies, prepaid insurance, and equipment. You see, these are all assets here. Then we come down to a bunch of credit balances. These are all liabilities and common stock. Our payables, notes and accounts, our unearned service revenue, and our common stock. Remember, dividends reduce our stockholders' equity account, so that's a debit. Our service revenues are revenues, which is a normal credit balance. And then our expenses are normal debit balances. So basically, our debits have to equal our credits. And this trial balance helps us to determine if they don't equal. Now, in a computerized system, of course, they're going to equal, but sometimes with our own manual entry, we screw them up and have debits and credits in the wrong way. Now, trial balances can be wrong. We can have recorded it to a wrong account, but the purpose of the trial balance is basically to make sure that debits do equal credits. Now, a trial balance isn't going to balance if A, a correct journal entry gets posted twice, the purchase of supplies on account is debited to supplies and credited to cash, C, a $100 cash dividend is debited to the dividends account for $1,000 and credited to cash for $100, or a $450 payment on account is debited to accounts payable for $45 and credited to cash for $45. Well, let's think about this. All a trial balance does is balance that our debits equal our credits. So a journal entry that gets posted twice is still going to balance. If we purchase supplies on account and we debit it to supplies and credit it to cash, well, what we screwed up, instead of crediting to accounts payable, we credited it to cash, but we're going to still balance there. But in C, if we have a $100 cash dividend that gets debited to dividends for $1,000 and credited to cash for $100, well, our debits aren't equaling our credits there, are they? We have debits of 1,000 and credits of only 100. So that our trial balance would not balance because we really need to credit to cash for 1,000. So we would be off. Our debits would be $900 greater there than our credits. Okay, so we're not going to focus a lot of time as we're relating to the various types of activities. I think I told you companies are involved in 3 types of activities: operating, which is really the purpose of why they're in business; investing activities; and financing activities. But we need cash, and cash is important to be familiar with the cash flow statement so we know that we do have enough cash to be sustainable down the road. I'm not going to pay attention to IFRS. These are international accounting standards, and I'm not going to be focusing on that at all in this particular class. So we will take another lecture and look at some examples.